Okay, so what I'm going to talk about right now, where there's been a lot of talk about these mega mergers and things like that, and so I'm just going to go down to that and talk about how it happened, a bit of background on the North American gold market, and then talk about why this transaction happened and potential implications for everybody else, I guess. Okay, let's get started. So basically, this is what it looks like. So we're going to have fewer apex predators now. The big are going to get bigger. And that's all I really need to do with that slide. Okay, so we're going to talk again about the state of the mining industry, Goldcorp's capitulation, and compensation. Newmont's rationale, and the risks to this transaction. And then I'll just finish it off. Okay, so in terms of the state, before the end of the year for our subscribers, we did a discussion about looking at the industry because we thought, well, hopefully in the first quarter of this year, we might see a pickup in the gold price. So let's just look at everything. So I looked at 26 gold producers, North American listed, not the Australian ones, just North American at this point. But what's interesting to know is just to put it all in perspective. I mean, the cumulative market cap at that time for those 26 North American listed companies was $100 billion. It's a big number, but it's $20 billion less than BHP's. And it's what Apple lost over 3 months was 4.5 times the cumulative market cap of all these companies. So yeah, it's a big number, but really in terms of the entire industry, not so much. And in terms of the entire equity markets, even less. And so in terms of the Canadian perspective, is that the latest mega mergers, some of the impact they're having on Canada is now your biggest gold producer, the chairman is American, and doesn't live in the States, and also now your new CEO is South African, who doesn't live in Canada either. And then now with this new mega merger that was announced this week, you take the other big gold producer and you convert it into the regional office of a US producer. So so you can see right there in terms of the, sorry, I did what I told Rick not to do. So you can see that, Barrick and Newmont are the biggest. And Goldcorp wasn't far behind. I didn't have Rand here, but they would have been around here somewhere. And so the whole idea now is to just get bigger. And so if we just take a look at the industry as a whole, so positive retained earnings. I know that's not a word that's used in the gold industry much because people would not, it's not a nice number. So it basically takes into account, like, if you look at the balance sheet on the equity side of the ledger, you could see it's an indication if the company's a going concern, if it's moving in the right direction. The average accumulated deficit, is about 1.3 billion with all these companies. There's a big range, but look at who's got the biggest deficit. Two of the companies involved in these mega mergers, Barrick and Goldcorp. And the other one who had the best retained earnings was Newmont. Who was the acquirer? Newmont. Who was the acquired? Goldcorp. Even though we say that Barrick, well, it was the bigger company of the merger with Randgold, there was no premium. And basically the people that are running the new Barrick are Randgold people, not Barrick people. And then if we look at free cash flow per share, I mean, it's important to make money, isn't it? So the average free cash flow per share was negative. Big range, but about 24 cents per share. I mean, half of them, a little bit over half, generated positive free cash flow, which is a positive. So if we look at the numbers, one of them was a Sanko, but that was really due to the sale of the asset. They sold a half of the asset to Goldfields. That's why they ended up with a big free cash flow positive. The ones that were negative, like Franco and Endeavour, they did a lot of capital spending. So it's surprising to see Franco down there, but they did a lot of spending on acquiring new royalties and that, and about 700 million, and Endeavour spent about $230 million in their growth projects in Africa. But then let's take it back to the mega mergers. Guys that are doing good, Newmont, again, looking good. Free cash flow per share positive. Barrick's looking good. Gold Corp, not so much. Working capital. So that's another thing. So if you're not making a lot of money, you better have some money. That way you don't go bankrupt. So the average working capital position of these companies, big range, but positive and not bad, $500 million. But you can see that $3.8 billion is wrapped up into Newmont, and there's another $2.6 billion wrapped up in Barrick. So those two companies are doing quite well. Who's not doing well? That one, Gold Corp. And so another thing that's happening in the background that's driving this desire to be a megalodon, I'll use that word again, is something I talked about last year in September, I think it was. So when I did the October, when I did that Precious Metal Summit panel, we talked about passive versus active funds. And this is a very important phenomenon that's been happening for the last few years. I mean, the amount of assets under management back in 2011 peaked at about 54 billion. So 94% of that was actively managed, only 6% passive. So 50 billion about of the 54 billion was actively managed. And these are people that give you money. So if you raise money, they'll give you money. Not only do they trade, but they're active in terms of they will, do a placement. And now you take that, and now you're sitting at the entire pie is smaller, about 30 billion. But now the amount of that pie that's actively managed has gone from 94% to 33%. So in all, the actively managed funds have dropped about 80%. The generalists who don't mind the sector just don't want to invest in specific companies and have all that business risk. They prefer ETFs. They prefer the GDXs and the GDXJs. High liquidity, anonymity, trading flexibility. So in the end, some of these megalodons have to start becoming almost like an ETF. They need that size. They need that liquidity. They need that to attract these kind of generalists. And so the poor performance of these companies generates a lot of activism. I mean, granted, the activism is from the active institutional equity, which is, as I said, less. So Paulson only owns 6% of Detour, but their activism led to them taking about 5 of the board members off recently. I mean, then we'll talk about Barrick. Barrick merged with Randgold September to become, at the time, the largest gold mining company. More recently, Newmont's pegged themselves a bit higher with the friendly acquisition of Gold Corp. But what's going to come out of that is like a Disneyland for investment bankers. You're going to have about $1.5 to $2 billion of divestitures over the last 2 years that both these companies have sort of committed to justify the transaction. So what we're going to see is these juniors, mid-tiers start buying assets from these majors. So it won't be as much that, oh, I'm going to own the junior and it's going to get taken out by the major. There may still be some of that. But right now, the seller is that company. You have no exposure to that unless you buy that company, but that's very liquid. It's not a junior. And the only exposure you would get, potentially, is with the company that buys it. So it opens up some opportunities for not only juniors, mid-tiers, Australians who want to be a bigger footprint into the Americas, potentially, but also private equity. And I would also include royalty and streamers, because the companies like the Barricks and the Newmonts want cash. They do not want equity. So if you have to finance the acquisition, you might look at a stream, a royalty, something like that, to help you get that done. Okay, Gold Corp, the capitulation and the compensation. Okay, so this is a slide that I showed 2 years ago, May 2017, so roughly 2 years ago. So we talked about Gold Corps and their acquisition of these low-grade gold, copper porphyries in Chile. Cerro Casale, Caspiche, Quebrada Seca. It was going against the grain of the industry. So the industry, let's say your Newmonts and your Barricks, had already done that. That's where they had all the impairments, doing all of this. And now they're going back the other way. It's sort of like you're going on this path, you don't know where it's heading, but then you see two people coming back, and they don't look so good. Do you keep going, or do you turn around? Goldcorp decided to keep going. So, you know, what we thought was that the last cycle, I mean, it clearly illustrated the issues about trying to build low-quality assets. It does not increase your NAV per share, but which was the CEO, the new CEO at that time, Garofalo's point. So basically, the market as well as us question the actual transaction. And so what did we get? So during the tenure, 3-year tenure, he joined about December 4th, I think it was 2015. It's underperformed the benchmark GDX every year. So you would have been better off buying the GDX. So as a generalist, I'm proven correct. Not me being a generalist, but for that generalist. The strategy of growing the production and reserves, this 20-20-20 plan, while reducing the AISC, sounds like the NAFTA plan. I like NAFTA, I don't know what the new one is. But the all-in sustaining costs, you know, it's a catchy phrase. And you need catchy phrases if you're going to talk to 1,000 people every day, and you need a catchy phrase. But in the end, the real 20% was a drop in the share price since he started to when he's basically seeded the company. So GG's market cap during his tenure dropped about $1.6 billion. But it wasn't a loss for everybody. So, like I said, Goldcorp was one of the only ones of its peer group, the only one of that 26 company with a negative working capital position, and still carrying about $2.3 billion in long-term debt. Generated negative free cash flow over the first 9 months of 2018, that's their last financials, and had one of the largest accumulated deficits of its peer group, Goldcorp. So if we assume the compensation in the last management circular in, I think it was May or March 2018, the total comp for those 5 executives would have been about $28 million for a change of control. Granted, that was using a $16 share price Canadian, now it's 13.7, but you get the idea. Current estimates have the CEO alone making about $8.5 to $9 million from this transaction. Okay, now let's talk about the other side. So Newmont. So one thing, if you listen to the conference call that they gave, one thing that was interesting was the CEO of Newmont, Gary Goldberg's statement that it was a transaction I didn't have to do, but I wanted to do. And so the history of that is almost when I joined Newmont back in the mid-2000s, 2005. Placer was just acquired by Barrick, and there was a lot of pressure on Newmont to do something bigger, better. We didn't. So basically, Newmont was chasing Barrick for about a decade. Now the combined company, Newmont and Goldcorp, will have a market cap of about 25 to 26 billion. And remember, what did I say about the market cap of the entire 26 was around 100 billion. So they're going to leap ahead of the new Barrick, and they'll be the top holding of the GDX ETF. The decision could be hubris, because hubris is not something that's anathema to a CEO, especially of a gold company. The CEO is retiring, and he might want to leave his successor at the top with the biggest gold mining company on earth. He will stay. He was supposed to leave Q4 of last year, but he's going to stay for another 3 quarters until the transition's done. So you already got a timeline as to how quick this is going to happen. Okay, so what struck me about Newmont from last year was this production profile, this so-called industry-leading production profile that, you know, looks kind of flat. So this profile is about 4 million ounces, you know, and this is typical. So once you get up to about 4 million ounces, it's very difficult to grow at a compound annual growth rate of 3 to 5%. And generate projects or execute on projects that also generate a 15% IRR at about $1,200, $1,250 gold price. So even though the near-term production, this is pre-acquisition, this was last year, was 4.9, 5.2 million ounces, the long-term was 4.4 to 4.9, so actually a decline. The important thing here is what they really wanted to do was have stable production. Stable production means they were making money. There was no point, like during the time I was there, is every ounce is sacred, you know, even if it makes $1 of NPV. So now with the acquisition of Gold Corp, you step up your profile. 2 million ounces. So the combined production right now, given what they said that they're going to produce this year, would be about 7.5 to 7.6 million ounces. Higher if you use the 2017 numbers. But the long-term profile is lower. It's 6 to 7. So what they want to be able to do is maintain a production profile that generates free cash flow. They're not telling you that it's going to, from here, it's going to be a 2 to 3% CAGR, compound annual growth rate. No, they're not saying anything like that. They're just saying we're going to be bigger. This is where we're going to get. This is where we're going to be at. This is we can maintain this. We can generate cash flow, and importantly, pay dividends. And jurisdictionally, this is an important slide because really, this is going to be the focus, the Americas. And for those guys who want to use this like an ETF, it's got liquidity, solvent, generates free cash flow, big working capital position, manageable debt. The issue is going to be that, you know, hey, but I don't want Africa, or I don't want Indonesia, or I don't want whatever. Newmont won't have that exposure like Barrick will. And also, this new Newmont will be the only one listed on the S&P 500. Okay, and so I'm a bit of a Larry David fan. So this reserves is not just about addition. So if you added the reserves, 52.8 million ounces, 68.5 million ounces, you'd get 105 million ounces. That's math. But it's not going to work out that way because about 16 million ounces is tied up in these low-grade marginal deposits that really don't generate a 15% IRR at $1,250. So effectively, the combined reserves, or what actually can be actually executed upon, will be much less. So the risks to this integration. So one big thing at Newmont is to manage your debt. And how you do that is whenever you do a covenants on any kind of debt, especially a corporate, you look at your net debt, which is your total debt, minus cash. So that number, net debt, over your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, is what banks look at. So if you're over 3 to 4, then you know they probably don't want you. But Newmont's was lower than 1. So their ability to fund like this is important because they don't want to go to the equity markets if they don't have to. Generate free cash flow, show them I got a strong balance sheet, give me more money, I'll keep paying it back. I'm a good partner, interest rates are low. So in the end, this will raise their net debt to EBITDA. But it won't be unmanageable, but it's something that they'll have to look at. The divestitures will be important in trying to get this back down again. The other thing is maintaining a dividend policy. So if you want to attract the generalists and also those people that want dividends, they tripled their dividend in March of last year to 56 cents per share for the year. Well, 14 cents per quarter, US. So, but its new share count is going to be about 818 million, if my math is right. So that will require an outlay of about $450 million, $55 million a year in dividend paying, if they maintain the same policy. The important thing when you do this and you integrate it is maintain your dividend policy. Don't keep changing it, because the dividend guys won't like that. So whatever they choose, they'll have to think that they could do it over the long run with that 6 to 7 million ounces. The other aspect of it, interestingly enough, is this savings. $100 million of annual savings pre-tax. Now, where's that going to come from? Because if that slide I showed you before about their assets, there's not a heck of a lot of commingling there. They're in Peru, they're in Nevada, the other guys are in Canada, they're in Mexico. Newmont's not big in Mexico. So there's not a lot of regional synergies at site. But the Gold Corp spends about $120 million a year on G&A. So where do you think that $100 million is going to come from? So I've been to Elko. I used to work for Newmont. This was seen as a big office because basically before, when I used to go there, it was basically a shack with a basement. So this is very impressive for Newmont in Elko. To go from this to this, I don't think so. So the integration is going to involve 4 people, 3 of them Newmont, but it's basically going to be run by Newmont. It's their culture that's going to pervade the new company. But we all know that in the resource sector, there is issues with the talent pool. So human resource-wise, they'll have a bigger talent pool to pick from. So this is another positive for them. So in terms of going forward, what does that do for everybody else and for themselves? So as you could see, the big circles here, strategic investments and a lot of the dots are really focused in on the Americas. Where the divestitures may occur will be isolated assets, marginal ones, and potentially some of them that are long in the tooth, just like when they got rid of Midas. The acquirers, juniors, like I said, mid-tiers, ASX will be important here because having working capital and the ability to fund the acquisition is vital. Private equity will play a role, and potentially the streamers and the royalty companies as well. It'll be like dreamland for the bankers for the next 2 years, trying to get 6 to 7% fees off of $1.5 to $2 billion of divestitures. Again, the focus, I think, will be on the Americas. Okay, summary and conclusion. I might just make this. Newmont and Randgold were the outperformers. Gold Corp and Barrick were the underperformers. It's not about who bought who. It's really about whose culture will continue. It's the Randgold culture that will continue in Barrick, and it's the Newmont culture that will pervade in Newmont. So Newmont's mega merger is like a great opportunity for them to increase their relevance with respect to generalist investors in the gold sectors and compete potentially directly with ETFs. It'll be the largest company and the only one listed on the S&P 500. It'll stand out for them. Barrick's motivation for this no premium merger with Randgold was to add more tier 1 assets that work at low gold prices while gaining the management team that they didn't have. So streamlined approach and a focus on returns, which is exactly what the chairman wants. The both will still continue to focus, as we've seen with the production profiles and managing expectations, generating free cash flow, sustainable production levels, less emphasis on growth. Good portion of Newmont's portfolio at least, will be in lower geopolitical risk jurisdictions. The States, Canada, Mexico, Australia. Access, like I said, to a talent pool is really important given where the industry is. And again, with the divestitures, the focus of the bankers, the focus of juniors, mid-tiers, multiple listed companies, and potentially the streamers. So I'll leave you with that. And then just this saying that I saw on a t-shirt. So be yourself, but if you could be a megalodon, be a megalodon. Okay, thank you.